Okay, we are recording. Hi there, everybody. I am doing this recorded lecture to go over the Chapter 13 PowerPoints with you and some of the things that we're going to be talking about in Chapter 13, namely current liabilities. So we'll see as we're going through and looking at the PowerPoint slides, much of this will be familiar to you as far as talking about current liabilities like accounts payable, notes payable, unearned revenue, things like that we've gotten practice with in previous chapters in this textbook, and then also previous accounting courses as well. But we do have a couple new things being introduced in this chapter, a couple new liabilities, I guess I should say, current liabilities being introduced in this chapter. And that has to do with gain and loss contingencies, for the most part, focusing on loss contingencies, because as we'll find out, gain contingencies we do not record, but loss contingencies, there is a recording process for some of them. And then also some of the liabilities associated with compensated absences like sick time and, paid time off and things like that. So, although some of it'll be familiar, from what we've talked about before, there are some new liabilities introduced in this chapter that we're going to go over together. So I'm going to share my screen with you and get Chapter 13 PowerPoint pulled up. All right, close this out. And okay. So Chapter 13, again, talking about current liabilities and then gain and loss contingencies. So some of these main learning objectives: describe the nature, valuation, and reporting of current liabilities, explain the classification issues of short-term debt expected to be refinanced, explain the accounting for gain and loss contingencies, and then indicate how to present and analyze liabilities and contingencies. So what is a liability? The technical definition, according to the Financial Accounting Standards Board, is the probable future sacrifices. And these future sacrifices could be either cash, if we're paying off the liability with cash. It could be, maybe paying off the liability with inventory. So that could be a probable future sacrifice, or it could be paying off the liability with some type of service or something like that. But probable future sacrifice of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. So, again, we've gotten practice with some of these liabilities, current liabilities, and now this chapter is introducing us to some more of these. Okay, so current assets, remember, current assets and current liabilities we expect to be used up as far as current assets, or paid off within the year or operating cycle, right? So some of our current assets that we've discussed before, cash, accounts receivable, prepaid expenses, supplies, prepaid insurance, right? Different things like that. Current assets we expect to be used up or converted to cash within a year or operating cycle. Same thing with current liabilities. We expect these obligations to be paid off or satisfied within 12 months or the operating cycle, right? So some of these different current liabilities, accounts payable, notes payable, we've gotten practice with both of those before. Current maturities of long-term debt. So this has to do with basically the portion of debt that's due within the next 12 months or within the year. So if you think about, a long-term liability like mortgage payable, for example, right? Standard kind of mortgage terms, 15-year mortgage, 20-year mortgage, 30-year mortgage, but the current portion is what's due within the next 12 months or within the next year. Short-term obligations expected to be refinanced. Dividends payable. We talk about dividends more in chapter 15, I believe. I think I made a note in the book. But we talk about dividends payable more when we go over stockholders' equity, in chapter 15. Customer advances and deposits and unearned revenues. Those are, basically the same thing, as we'll see when we're going through and looking at examples of each one of these or defining each one of these. This is when we've received a deposit or we've received payment in advance, and then we owe some type of product or service for that. Sales tax payable, income taxes payable, employee related liabilities. Again, I mentioned earlier, for example, like compensated absences. That's like sick pay or vacation time, paid time off, things like that. And then also this refers to payroll tax expense, employee related liabilities, right? All right, so accounts payable, again, probably the most familiar to us of the current liabilities, maybe that we've got the most practice with. These are balances owed to others for goods, supplies, or services purchased on account. And so hopefully we remember these credit terms or terms of the sale, 2/10, N/30, 1/10. EOM stands for end of the month. So 2/10, 2% off if paid within 10 days. Right? 2% off if paid within 10 days. Net amount due, N/30 net amount due in 30 days, or 1/10, 1% off if paid within 10 days. EOM again, end of month. And usually, just like it shows here, if we're extending credit to a customer, or if a customer is extending credit, or but a vendor or supplier or something is extending credit to us, common kind of pay arrangements are like it's due in 30 days or it's due in 60 days, right? Okay, notes payable. Again, we've gotten practice with notes payable before. We talked about notes payable back in the chapter when we looked at the present value calculations, because we record some of these using those present value factors that we get from those tables. So written promises to pay a certain sum of money on a specified future date. Accounts payable, again, as we saw in the previous slide, arises from purchases of goods and services on account. Notes payable is the same thing. However, notes payable, again, as we've discussed before, there's a more formal arrangement, a written agreement, a promise to pay a certain amount. And the example that I always give in class, so I'm sure you guys have heard this before, is that, if we think about like a loan on a car, we oftentimes call that a car note. And so to us personally, then a car note is what we owe on our car. And say you have a 4-year loan and maybe the payment is $300 a month, that's a written formal agreement to pay $300 a month for 48 months, 4 years until it's paid off type thing, right? So where accounts payable, it's kind of just arising in the normal course of business, purchasing supplies, purchasing inventory, purchasing materials, whatever the case may be. Notes payable is a more formal written agreement, right? These can be classified as short-term or long-term, and maybe interest-bearing or zero interest-bearing. Interest-bearing, the interest rate is explicitly stated. So interest rate explicitly stated. In other words, they're going to say like it's 6% note, or it's an 8% note, or it's going to be explicitly stated, right? Zero interest bearing, it's, you would consider it implicit, right? Like we're going to see an example where, okay, they're going to give us $100,000 loan, but when we pay it off, we got to pay off 102,000. So then that's 2,000 worth of interest. There's not an explicitly stated interest rate, but there is a cost of borrowing associated with it, right? We do know that amount of interest on the loan. Okay, so here's our example. It says Castle National Bank agrees to lend $100,000 on March 1, 2017 to Landscape Company. If Landscape signs a 100,000 6% 4-month note, right? So again, the interest rate is explicitly stated, right? Landscape records the cash received on March 1 as follows. So we take out a loan if we're Landscape Company, right? We take out a loan. So then we've got cash going up, but then now we also owe. So then notes payable is going up as well, right? So we're debiting cash, crediting notes payable. It says if Landscape prepares financial statements semi-annually, it makes the following adjusting entry to recognize interest expense and interest payable at June 30th. So remember that interest calculation is principal times rate times time, right? Principal times rate times time is how we calculate that interest. So again, principal 100,000, rate 6% times time. So we took this note out on March 1st, and now this is June 30th. So we've incurred interest now. We will have to pay interest for March, April, May, June, 4 months, 4 out of 12 months, right? So $2,000 worth of interest. So we're debiting interest expense, crediting interest payable. And so once we pay this off to the Castle National Bank, right, assuming we're a Landscape Company, once we pay this off to Castle National Bank, we're going to have to pay not only the 100,000 that we initially borrowed, but the 2,000 in interest too, right? So we're going to have to pay 102,000. So it says, at maturity, July 1, Landscape records payment of the note and accrued interest as follows. So we know we're going to be paying off 102,000. We're going to have to credit cash for 102,000. Our debit is the 100,000 to notes payable. When we pay it off, we do the opposite. So we debit it. And then the debit to interest payable. When we pay it off, we do the opposite, right? Is what that would look like. Okay, 0 interest bearing note. So in this one, the interest is not explicitly explicitly stated, right? So, but they're saying the present value is 100,000. When we pay it off, we have to pay off 102,000. So we know that that's going to be $2,000 worth of interest. That's the cost of borrowing, right? And so what's going to happen is we use this discount on notes payable. And eventually when this note matures or when we pay this note off, again, assuming we're Landscape Company, when we pay this note off, this 2,000 is what's going to be charged to interest expense. So it says on March 1, Landscape issues 102,000 4-month 0 interest bearing note to Castle National Bank. The present value of the note is 100,000. Landscape records this transaction as follows. So we know we're going to have to pay off 102,000. That's what we're crediting notes payable for. They're actually, even though we have to pay off 102,000, they're giving us 100,000 cash. So cash is going up. And then we're also debiting the discount on notes payable. And then, you know, again, as we'll see, this discount on notes payable ends up, you know, debit, interest expense, credit, discount on notes payable type thing, right? This debit discount on notes payable ends up becoming our interest expense, essentially recorded as interest expense. So like it shows at the bottom of here, discount on notes payable is a contra account to notes payable and therefore is subtracted from notes payable on the balance sheet. It represents the cost of borrowing and thus the interest expense chargeable to future periods. Okay, dividends payable. Again, we talk about dividends payable more in chapter 15. Chapter 15, we go over the stockholders' equity portion of the balance sheet more in depth. So we go into dividends. But basically, when a company issues a dividend to their stockholders, basically they're distributing essentially part of the equity, whether they're distributing stock dividend or if they're distributing a cash dividend or what have you, right? It's an amount that the corporation pays out to their stockholders. And so that's what it's showing us here. Amount owed by a corporation to its stockholders as a result of board of directors authorization. And so that's called the date of declaration. And again, we get more into this in chapter 15, but this is the board of directors authorization. This is the date of declaration. And so the date of declaration is when it becomes a liability. When the board of directors declares the dividend, that's when it becomes a liability, and that's when we have to record it as a liability, right? So it is a current liability. It's generally paid within 3 months. Undeclared dividends on cumulative preferred stock not recognized as a liability. Dividends payable in the form of additional shares of stock are reported in stockholders' equity. Customer advances and deposits. Again, these are, we could think about these like unearned revenues is what we have used before and what we've got practice with before. But this is a customer making a cash deposit for some type of product or service. And so it is a liability to us because then we owe some type of product or service, right? And just like it shows at the bottom here, this can be classified as current or long-term, depending on the arrangement with the customer and when this obligation is going to be satisfied, right? When the performance obligation is satisfied. Okay, unearned revenues. Again, we've talked about these before. It shows us some examples here. I'm not going to read through all of these. Hopefully we have an understanding of these, but when we purchase something in advance, whether it's a plane ticket or we purchase a gift card or something like that, the company books it as unearned revenue until the day we take the flight, for example. Then the airline technically earned it. Or say we purchase a Starbucks gift card, to give for Christmas or whatever, and until that gift card is used, it's unearned revenue to Starbucks, right? And until it's used, then it becomes earned revenue type thing. So we've talked about these before. I think we have a couple kind of brief exercises that we'll get practice with some of these again, but I'm not going to spend too much time on old stuff, right? I want us more to focus on some of this newer stuff that we're looking at. All right, so here's our example of that. It says Allstate University sells 10,000 season football tickets at $50 each for its 5-game home schedule. Allstate University records the sales of season tickets as follows. So we would debit cash, credit, unearned sales revenue. And this is for, 5 games. So again, we're going to take this 500,000 divided by 5, and we're going to recognize 100,000 per game. So then every time we have a game, we're going to debit unearned revenue, credit revenue. We've all seen that several times, I think. So, okay. Sales tax payable. Again, we got a little practice with this in previous accounting courses, principles of accounting, namely. And so remember with sales tax payable, like we've said before, when you go to the store, for example, you go up to Walgreens and buy something or whatever, say the product is $10. Well, when you get up to the cash register, you don't pay $10 even, because Walgreens charges you sales tax. They collect sales tax from you. And then Walgreens has to turn around and pay that sales tax to the Department of Revenue. So sales tax payable is a liability to Walgreens because they, even though they collected the cash from you, they've got to turn around and pay that to the Department of Revenue. So that's a liability to the retailer. So just like it shows here, retailers must collect sales tax from customers on transfers of tangible personal property and on certain services, and then remit to the proper governmental authority. So this one says, prepare the entry to record sales tax, assuming there was a sale of 3,000 when a 4% sales tax is in effect. So 3,000 times 0.04. So sales tax is going to be 3120. So, or excuse me, sales tax is 120. So the retailer is going to collect 3,000 plus 120, right? 3120. So debit cash for 3120 or accounts receivable. It could be a debit to accounts receivable also. But in this case, debit to cash, credit to revenue, credit to sales tax payable. Okay, not too bad. I think we've seen that before. Okay, here's another example. And so in this example, this is when a company does not record sales tax separately on the initial transaction. They have to go back and do an adjusting entry, basically. So this one says many companies do not segregate the sales tax and the amount of the sale at the time of the sale. Instead, the company credits both amounts in total in the sales revenue account. So it credits the entire amount into sales revenue, and then it has to back up a portion of it. It has to back up the sales tax payable and basically adjust that account. So this one says, assume that the sales revenue account balance of 150,000 includes sales tax of 4%. Prepare the entry to record the amount due to the amount due the taxing unit. Again, the amount due to Department of Revenue or whatever. And so on this one, what we have to do is we have to take the total amount divided by 1.04 to get that percent that represents the sales tax within that. And so you see that here. 150,000 divided by 1.04, and that equals $144,230.77. And that represents the actual sales revenue. So if we take the 150 minus the 144, again, the difference there is actually the sales tax. And so we would debit revenue, credit sales tax payable for that amount. All right. Income tax payable. Businesses must prepare an income tax return and compute the income tax payable. We get practice doing this in our taxation course. But whatever taxes we owe, whether it's sales tax or whether it's payroll taxes or it's income taxes, you know, whatever taxes we owe are a current liability because they have to be paid, pretty quickly to the governmental agency, usually within, every quarter, every 3 months, whatever. And that's what it's saying here. Corporations must make periodic tax payments. Difference between, difference between taxable income based on tax laws and accounting income based on GAAP sometimes occur. We talk about that more in taxation. We talk about that more in chapter 19. But the easiest way that I can explain this to you is that, we take net income from our income statement, right? We've calculated this many times. We've got many practice. We've practiced this many times together, right? So we calculate net income from our income statement. And then we use that net income basically as a starting figure on our tax form. So we start with net income, but then we take off any tax deductions. And by tax deductions, I mean, we get deductions, for example, like I save for retirement, so that's a tax deduction. I save for my daughter's college, so that's a tax deduction. Also, there's a standard deduction that, every person gets. Right now the standard deduction is 12,500, I think is still the amount. I don't know. It sometimes goes up, it goes down a little bit, but 12,500 seems to be the number that's sticking in my head. But so we've got some of these deductions that we get to calculate to then calculate taxable income. Depending on, also, you think about dependents, and if you are a caregiver for an older relative or something like that, those are some of the things that you get to claim as tax deductions. If you have a large amount of medical expenses, charitable contributions, right? Things like that. And that's why there's a difference between net income GAAP on the income statement and taxable income on our tax forms. Anyway, we talk about that more in taxation and more in chapter 19. All right, employee-related liabilities. So I mentioned these earlier at the beginning of the PowerPoint, things like payroll deduction, payroll tax expense, compensated absences, things like paid time off, sick time, vacations, bonuses, things like that, and how these are recorded. All right, so payroll deductions, for those of you that had me, and I think it's everybody in class this semester, for those of you that had me for Principles of Accounting, we did do a lot of these calculations in Principles of Accounting 2, excuse me, chapter 7, chapter 8 of our Principles of Accounting textbook. So we'll get some more practice with it here, but basically we talk about FICA, Federal Insurance Contributions Act. And so with FICA, we've got Social Security taxes and Medicare taxes. Social Security taxes are 6.2% for up to 118,500 of wages. Now, this number is based on when this textbook was published. Right now, I believe currently the number is 137,500. But honestly, I haven't looked at it in over a year. So that's, I think the last time I looked what it was, 137,500. What, honey? Sorry. Okay, and then Medicare. So let me back up a second because my daughter interrupted me and it made me lose my train of thought. So when we think about Social Security, so when people retire, they should get Social Security, right? And so right now, people that are of retirement age get paid their Social Security benefits. And Social Security benefits are based on what you have paid in over your lifetime. And so that's based on income, right? So, a person, for example, that has earned on average 50,000 per year is going to get more Social Security benefits than someone who's earned on average 25,000 a year, right? Because it's based on a percentage. You pay in based on a percentage of your income. So, at retirement age, we should get Social Security. And so that's what it's talking about here with Social Security. Medicare, on the other hand, which again, Medicare is part of FICA as well. FICA includes Social Security and Medicare, but Medicare is the health insurance that people get, at retirement age, right? So Medicare is 1.45%, and that is on all income. There is not a threshold like we saw with Social Security. Okay. Unemployment taxes. So we know that the employer has to pay unemployment taxes on its employees up to $7,000 in wages. And so just like it shows here, the unemployment tax rate is altogether 6.2%, but usually that 6.2 is split between the state is 5.4%, and then you pay the rest to federal. So in this case, state 5.4%, then we would only pay 0.8% to federal. So that's what it's saying here on this third kind of bullet point. If the employer is subject to state unemployment tax of 5.4% or more, it receives a tax credit not to exceed 5.4% and pays only 0.8% to the federal government. All right, payroll deduction. So this is just showing us again for those of you that had me for Principles of Accounting 2, you will remember these because we got a lot of practice with them. We'll get some more practice with them in this chapter, but remember the employee has to pay income tax, their portion of FICA, right? So employee portion of FICA, and then union dues, or also there could be deductions for health insurance. There could be deductions for charitable contributions. There could be deductions for retirement, right? But the employee would pay those. And then the employer has to pay their share of FICA, and then FUTA and SUTA, federal unemployment, state unemployment. And so when we think about, okay, Social Security is 6.2%, but actually 12.4% is being paid in on your behalf because there's an employee share and an employer share. So employee pays 6.2%, employer pays 6.2%, right? So you're actually getting 12.4% paid in on your behalf. And then Medicare, member, is 1.45%. So again, getting 2.9% paid in on your behalf, because again, the employees paying 1.5, the employers, or 1.45, excuse me, the employees paying 1.45, the employers also paying 1.45. So a self-employed individual has to pay these entirely themselves. Okay, here's our example. It says assume a weekly payroll of 10,000. So that's going to be our expense, right? The total amount of salary and wage expense, the weekly payroll, 10,000. Entirely subject to FICA and Medicare, a total of 7.65%. And again, they're getting this 7.65 because they're taking 6.2% Social Security, 1.45% Medicare. Federal unemployment 0.8% and state unemployment 4%. So it says with income tax withholding of $13.20 and union dues of $88 deducted. The company records the salary and wages paid and the employee payroll deductions as follows. So again, employee is responsible for income tax, federal income tax withholding, that comes out of their check. They're responsible for FICA and Social Security and Medicare, and then also the union dues, right? So this journal entry, debit, salary, wage expense, credit, the federal income tax withholding payable, credit, FICA taxes payable, credit, union dues payable, and then credit cash. And, you know, basically this would be like the employee's net pay. And remember, this is like the gross pay is how we looked at recording those. There is a course this semester, accounting for payroll. Some of you I know are in it, and so we're going to get a lot more practice with this, but it does come up in this chapter as well. All right, now here's the employer's taxes. So the employer does not, right? The employer doesn't have any income tax withholding. That came out of the employee's check, but the employer has to pay the 7.65% for Social Security, Medicare. They have to pay FUTA, federal unemployment. They have to pay SUTA, state unemployment. So it's a debit to payroll tax expense for the total amount, credit to FICA taxes payable for the employer's portion, credit to FUTA taxes, credit to SUTA taxes payable. All right. Compensated absences, again, we discussed these before, things like sick time, paid time off, vacation time, things like that. And so what it tells us in our book, if we have to accrue these or not, is if they carry over into different accounting years, right? So for example, if we are a company and we allow employees to have 5 sick days per year, but they have to use those 5 sick days. The sick days do not roll over. They have to use those 5 sick days in a year. And if that's the case, then we're not going to have to accrue it, because if the employee never got sick and never took the sick days, we don't owe them anything for it, right? But if those sick days were to roll over then to the next accounting year, to the next year, then we'd have to accrue them, because then we owe them, at which point they're a liability. And so it's kind of the same justification for vacations. You know, if we give employees 2 weeks vacation a year and they are required to use those 2 weeks in that year, their vacation does not roll over. They're required to use them that year. There'd be no reason to accrue a liability for it. But if they roll over and the vacation days roll over, then we would have to accrue a liability. So, and you know, it's up to the company, you know, how they want to do it, but you know, generally speaking, that's kind of the distinction that your book talks about in here. All right, bonus agreements, payments to certain or all employees in addition to their regular salary or wages. So for this one, this just becomes additional salary and wage expense. So we're just debiting salary and wage expense essentially on this one. Oh, I thought the journal entry for this popped up, but I guess not. Current maturities of long-term debt, so portions of bonds, mortgage notes, and other long-term indebtedness that mature within the next fiscal year. Excludes long-term debts maturing currently. So we would exclude any long-term debts maturing currently if they are going to be retired by assets accumulated that are not current assets. If they're going to be refinanced or retired from the proceeds of a new debt issue, or if they're going to be converted into capital stock. Basically, if we're not going to use our current assets to pay them off, if we're taking out a new loan to pay it off, or if we're converting the debt to stock instead, right, we would exclude them from current liabilities. Short-term obligations expected to be refinanced. You know, again, if it's a short-term debt that then we're expecting to finance into a long-term debt, we would exclude it from current liabilities. Just like it shows here, we must intend to refinance and be able to demonstrate the ability to refinance either through providing some type of financing agreement, proof of a financing agreement, or actually going through and having the refinancing completed already. All right, contingencies. This is a little bit of a new thing for us. Gain contingencies, loss contingencies. The definition that we have here, according to FASB, an existing condition, situation, or set of circumstances involving uncertainty as to possible gain, which would be a gain contingency, or loss, which would be a loss contingency, to an enterprise that will ultimately be resolved when one or more future events occur or fail to occur. So we're going to see with the gain contingency, we don't generally recognize that until it happens. Loss contingency, it depends. If the loss contingency is probable and reasonably estimatable, we would record it. So some typical gain contingencies: possible receipts of monies from gifts, donation, asset sales, possible refunds from the government in tax disputes, pending court cases with a probable favorable outcome, tax loss carry forwards, which we talk about more in chapter 19, and also in taxation as well. Just like it shows here, gain contingencies are not recorded, and generally speaking, only disclosed if the probability of receipt is high. So maybe it might be a note disclosure in the financial statements, but only if probability of receipt is high. Loss contingencies, again, these could be lawsuits, several different loss contingencies that your book talks about. And I'm trying to find right now what page it starts talking about these on, so I can tell you. Loss contingencies start on page 674. So some of the loss contingencies: litigation claims, assessments, guarantee or warranty cost, consideration payable, environmental liabilities are some examples of these. But probability, we're looking at how probable the loss is. So probable is like when we expect it to happen, right? Kind of a step down from that. Reasonably possible, and then down from that, remote, that it will happen. It's a remote chance that it'll happen. And so we record these when they're probable or reasonably estimatable. So here it's showing us for each one of these levels of probability, how these are handled. So again, if it's probable and reasonably estimatable, and that's kind of, I think, a piece that comes up maybe on the next slide or something, but if it's probable, we would accrue the liability. Or if it's not reasonably estimatable, it might be a footnote instead. If it's reasonably possible, footnote. If it's remote, ignore. And so here's our example of that. It says Scorsese Inc. is involved in a lawsuit at December 31st, 2017. Prepare the December 31 entry, assuming it is probable that Scorsese will be liable for $900,000 as a result of this suit. B, prepare the December 31 entry, if any, assuming it is not probable that Scorsese will be liable for any payment as a result. So in the first one, letter A, it's probable and we know the amount. So it's reasonably estimatable. We're going to record it, right? In the second one, it's not probable. So we're not going to have an entry on that one. So an example of those for letter A, when it's probable and reasonably estimatable, then we would debit lawsuit loss, credit lawsuit liability. B, again, because it's not probable, there'd be no entry necessary. This chart or graphic is out of your book, page 675. I'm not going to read through all of this. It's there for you guys to read through, but it just gives us some examples of some things that are usually accrued as a liability, not accrued, or could or could not potentially be accrued. But we talked about some examples. Again, you guys are welcome to read through that. It has that available for you in the book. Common loss contingencies, and I mentioned this earlier when we started talking about loss contingencies. Litigation claims, assessments, guarantee and warranty cost, premiums and coupons, environmental liabilities. So litigation and claims and assessments, this could be a lawsuit or something like that. Guarantee and warranty costs, when we sell a product and we offer a warranty on it, though there are expenses associated with offering a warranty. Premiums and coupons. This could be like if we, and the example your book gives us, if we, offer some type of product if a customer turns in so many box tops, right? Then there's a liability associated with that. And then environmental liabilities, depending on what industry we're in, this could include, some type of liability for cleanup after our production process or extraction process in the case of natural resources, what have you. All right, so litigation claims and assessments. Companies must consider the following factors in determining whether to record a liability with respect to pending or threatened litigation and actual or possible claims and assessments. So time period in which the action occurred, probability of an unfavorable outcome, the ability to make a reasonable estimate of the loss, right? So probability and reasonably estimatable. Guarantee and warranty costs. So promise made by the seller to a buyer to make good on a deficiency of quantity, quality, or performance in a product. So the difference between assurance type and service type. Assurance type, this is like the type of warranty included in the sale price. So, for example, you buy a new computer, they tell you that, the computer comes with a 1-year warranty. That's an assurance type warranty. The service type warranty is what they charge extra for. So again, you buy a new computer, they tell you when you buy the computer, this computer comes with a 1-year warranty. But do you want to purchase an additional 2-year warranty, right? So that service type warranty is the one they try to charge you extra for. And I think that's what it tells us here. So assurance type warranty, again, warranty that the product meets agreed upon specifications in the contract at the time the product is sold, should be expensed in the period the goods are provided or services performed, should record as a warranty liability. So it'd be like debit, warranty, expense, credit, warranty, liability type thing. Service type warranty, warranty that provides an additional service beyond, so that additional, that extra cost warranty, right? So additional service beyond the assurance type warranty. Recorded as a separate performance obligation, usually recorded in an unearned warranty revenue account. And then we recognize revenue on a straight line basis over the period of the service type warranty is in effect. Consideration payable. So again, this was the example I used earlier of like the box tops. If a company says, hey, if you mail in so many box tops, we'll give you a free bowl or something, free hat or something like that. They have to consider that they're going to have a little bit of a liability based on how many customers redeem this offer, right? So consideration payable, companies should charge the cost of premiums and coupons to expense in the period of the sale that benefits from the plan. Company estimates the number of outstanding premium offers that customers will present for redemption. Company charges the cost of premium offers to premium expense and credits premium liability. And then environmental liabilities, again, especially dealing with natural resources. If we think about a gold mine or a coal mine or an oil field or something like that, after we extract the asset from the earth, after we extract the gold from the earth, after we extract the petroleum oil or whatever from the earth, right? We have to then dismantle that oil rig, or we then have to put that land back to its original form before we dug big holes to dig for gold or whatever, right? So that's what they're talking about here with this asset retirement obligation. So a company must recognize an asset retirement obligation when it has an existing legal obligation associated with the retirement of a long-lived asset, and when it can be reasonably estimate the amount of the liabilities. Asset retirement obligation should be recorded at fair value. And so again, some of these examples of environmental liabilities or asset retirement obligations: decommissioning of nuclear facilities, dismantling, restoring, and reclamation of oil and gas properties, certain closure, reclamation, and removal cost of mining facilities, and then closure and post-closure cost of landfills. Self-insurance is another loss contingency discussed in this chapter. And basically what the self-insurance is we're not paying an outside insurance agency. We're basically saying that we are self-insured, which means that we will cover any of our cost associated with that, right? So self-insured is essentially we are assuming the risk. We're not paying an insurance company insurance to assume risk. We are self-insuring or assuming our own risk. And so just like it shows here, this might be disclosed in the financial statements. In this one, it says we are self-insured for certain insurable risks consisting primarily of employee health insurance programs, as well as workers' compensation, general liability, automobile liability, and property insurance deductibles or retentions. We fully insured future risk for long-term disability and in most states workers' compensation, but maintained a self-insured position for workers' compensation for certain self-insured states and for claims incurred prior to the inception of the insurance coverage in Colorado in 1997. Anyway, it's just showing us an example of this. Presentation and analysis. Again, we've prepared plenty of balance sheets together, so we know what the liability section is all about. We list our current liabilities first, then our long-term liabilities. With the current liabilities, they can either go in order of maturity, descending order of amount, or the order of liquidation preference. It's up to the company. Here's an example of current liabilities section here, or two examples rather, for Best Buy for 2014, 2013. Okay, I think we're probably good with that. Just like it's showing here, if a company excludes a short-term obligation from current liabilities because of refinancing, it should include the following in the note to the financial statement. So a general description of the financing agreement, the terms of any new obligation incurred or that will be incurred, and then the terms of any equity security issued or to be issued. So that's what they're showing us down here. On January 19th, 2018, the company issued 50,000 shares of common stock and received proceeds totaling $2,385,000, of which $2 million was used to liquidate notes payable that matured on February 1, 2018. Accordingly, such notes payable have been classified as long-term debt at December 31, 2017. Okay, presentation of contingencies. Again, disclosure should include the nature of the contingency, an estimate of the possible loss or range of loss, or a statement that an estimate cannot be made. Some other of these contingent liabilities that companies should disclose: guarantees of indebtedness to others, obligation of commercial banks under standby letters of credit, guarantees to repurchase receivables or any related property that have been sold or assigned. And this is just showing us an example of how one of these loss contingencies can be disclosed here. You see it up here, the note, and then the following expenses associated with that. Again, I'm not going to read through the whole thing. You guys, this is in your book. Actually, I'll tell you real quick because I've got my book opened up here if I can find it now. Page 686 of your textbook. All right, so some of the different ratios that we can do, or the analysis that we can do of our liabilities or of our financial statements, and these are considered liquidity ratios because we're just looking at our most liquid assets and our current liabilities. So current ratio, current assets divided by current liabilities. So they're using the 2014 numbers in here. So you see, this is our total current assets, our total current liabilities. So 1.41 times, this means that for every $1 of current liabilities, we have $1.41 of current assets, is how we read that. And then the acid test ratio, this one is very similar to the current ratio. The denominators obviously are exactly the same. The difference comes in the numerators because with the acid test ratio, we do not include inventory. So there's no inventory in the acid test ratio. In the current ratio, we did include inventories and other current assets. In this one, we would not include inventory, and then we wouldn't include those other current assets, which are, you know, another name for prepaid expenses, right? So once we subtract out those two things from the numerator, that makes our ratio smaller. So then on this one now, we've got 0.57 times, which means that for every $1 of current liabilities, we have 57 cents of these most liquid assets, or these most quick assets. Another name for the acid test ratio is the quick ratio, because it's our assets that can be converted to cash quickly, right? All right, here's some of the exercises that I have picked out for us to do, and we will start on those straight away. Wednesday, January 2nd is our first class. So we'll work on these in class together, and I will see you guys then. Let me stop sharing this for a second. I'm getting so excited. I'm like, woohoo, that was 47 slides. It takes a while to do that. Hi there, everybody. Okay, I will see you guys soon. Bye-bye.